Here is an indicator that I developed, I believe, a year or two ago, and it basically shows you how many days since a big move, and a big move you can define. In this case, it's 0.01 or 1%. So it's been 85 days since a 1% move, either up or down. The current day's close minus the previous day's close, that absolute value difference between those divided by the previous day's close. And so it's been 86 days. I read that wrong. 86 days since a big move. And how does that compare to the past? This is interesting indicator. And if we put a line, let's put the line in here for reference. I'm going to add a line in this. Here's the indicator. Here's the open code for that. You see this is commented out right here. This also, if you uncomment this and comment this out, you can see the days since basically a range. The range is 1%, while this is a move from the previous day's close, the way it's set up now. But I'm going to add a line here. This could be plot 1. I don't know why this is plot 4. And plot 2 is let's put a line in at 45, or let's see, here's the highest point. See, 42. Let's put it at 42. That's the highest point before this set of spikes right here. And so I'm going to put plot 2, 42, and it's going to show up there, and you'll see that. So the colors on this changed, but that's okay. And you see this line. This is a reference line I wanted to put to see where these spikes are historically. We're going to go back to 1997 and take a look at this. And so we're going to scroll back. I'm going to change this so it's easier to see. There you can see this value more easily. So we're going to scroll back. 42 is the highest. This is in the financial crisis in 2007 through 2009, and you get a lot of big moves, and so there's not many days between 1% moves here, and so you see kind of a flat line down here. And we know that volatility is higher in bear markets than in bull markets. So we're going to continue to scroll back here. Here's one. Before the financial crisis, there was a it's 36. That value is 36 right here. You can see it. Click on it, 36. So that's the highest before our reference line of 42. Continue to scroll back. Another time period here, 2001, 2002, 9/11. We had a little bit of a bear market from 2001 through 2003, and there was a lot of 1% moves because you don't see this line, the spikes getting very high, so there's not many days between 1% moves. And so we continue to scroll back, and this number is consistently staying around 10. And so there's less than 10 days typically between a 1% move. And you continue to scroll back. You get back here. This is the beginning of E-mini S&P data. In 1998, you have this number at 20. In 1997 at 22. And so here's a reference line up here at 42. So we can see going forward that 2007 was 2005, 2006, beginning 2007. Kind of was similar to what we are in now, but where we are now is even greater. A little bit of time period here in 2010 and 2011, and it just kind of builds 2013, 2014, and it's you think, wow, it's been a long time. Volatility, the cycle of volatility should give us another bear market. Bear markets, well, they don't die. Bull markets don't die on just based on a certain amount of a cycle of volatility. So the market is not tied to a cycle of volatility. It doesn't have to go down just because it's been a certain amount of time since the volatility has been high. But typically there is more of a quicker cycle where if the markets have been this the volatility has been this small, then there is a bear market to follow. But that has not been the case in recent years. QE, government intervention, with printing money, low interest rates, and so you see the highest number we've had in the E-mini S&P data is 86. We're currently on this streak of 86. In 2017, actually at the end of 2016, September 2016, you see us hit that 42 number, 43, that hits 43, and then we get this number right here. These two numbers around here, around 50. What number is that? 54. And then we get 58, and now we're at 86. So it continues to go up. It's strange because the market continues to go higher in narrower ranges. And so it's the best case scenario for bulls. The risk-adjusted turns for buying and holding are getting greater and greater and greater. And as volatility and pullbacks go to zero, those returns related to volatility and risk go higher and higher, and recency bias will have people looking at this and coming in and jumping in on this, and this could continue for a while, but it's more extreme than it's ever been. So it's not just your imagination, and that's the point of this indicator. And you can look at this as, wow, it's the cycle. We have this cycle here of low volatility. We're going to have a bear market because we're due for one. You don't get a bear market because you're due for one, but rather look at this indicator and say, this is the trend. Oftentimes we look at trends and say, is the trend up or is it down? But there's also other ways to look at trends, such as the type of market we're in, and the trend based on the type of market we're in is very low volatility, and until that ends, you have to take a look at methods that will take advantage of low volatility in the stock market. Most of our trades lately in this week have not even been in the stock indexes, been in crude oil, gold, silver, soybeans, because it is more difficult to trade a market that doesn't fluctuate. As a day trader, you want a market that fluctuates. And so that is this indicator. You can get that. You can download this, and I'm going to share that with you. And it's more of an interesting indicator, not a strategy indicator, but possible you can develop a strategy out of it.